You put money into your bank account every payday, and it feels like it just sits there, perfectly still. When you open your banking app and see that balance, it gives you a sense of security, like that cash is right there waiting for you. In reality, your bank uses those deposits to support mortgages, auto loans, and business lending while paying you very little in return. That static number on your screen obscures the fact that your savings are actively funding the bank's daily operations. This happens at a massive scale. Your paycheck joins a reservoir of capital that the bank routes into mortgages, auto loans, and business lending. These loans generate a significant stream of income for the institution. While the bank keeps the majority of those earnings, they may only return a few pennies in interest to your account. The responsible habit of saving your money becomes the exact fuel for the bank's revenue stream. This is not a secret arrangement. It is the standard operating model for most major national banks. Most of us opened our first savings account years ago and simply left it there, allowing our money to sit on autopilot for a decade or more. We tend to assume our interest rate is normal and that every other bank is offering the same deal. Because we rarely compare the numbers, we end up in one of the most lopsided financial arrangements possible, where the bank's profit towers over our own return. When we stop looking at the interest rates, the bank is able to keep the vast majority of that upside for itself. I kept my savings at the same big national bank for nearly 10 years. It was the same account I'd had since my early 20s, and I never checked the rate. That changed when I actually looked at my annual interest statement for the first time. After keeping thousands of dollars in that account for a full year, the bank paid me less than what I spend on a single weeknight takeout order. My money worked hard for the bank daily, yielding almost nothing for me. Seeing that math makes it clear that your bank's priorities and your savings goals are not aligned. You cannot change how banks use deposits, but you don't have to accept the smallest payout. There are federally insured institutions that pay significantly more than the rates found at traditional big banks. Within the standard coverage limits, your money in these accounts has the exact same federal protection as your current bank. The money is still accessible, even if moving it between different institutions takes a little bit of time. The main difference is that a much larger portion of the generated return flows back to you. Moving those funds today ensures your deposits work for your future instead of just the bank's bottom line. To find out how your current account stacks up, you need to look at your annual percentage yield, or APY. This is the real rate of return you earn on your savings over 1 year. Pull up your banking app now and find that number. It's often tucked away in the account details. If your APY is close to zero, you have just identified a massive gap between what your money is earning and what it could be. Next, we're going to look at the specific mistakes that keep people stuck in low-yield accounts and map out a step-by-step plan to fix it. Once you see exactly where that profit goes, every strategy we discuss next will make complete sense. Have you ever thought about what happens to your cash the second you slide it across the counter or hit deposit? Once you track the precise mechanical steps a bank takes with those funds, you see the real reason they pay out such minuscule interest rates and why they have absolutely zero internal motivation to change them. Most of us assume our money sits untouched in a vault, locked inside a tiny box with our name sharpied on it. In reality, the banking system treats the idea of money at rest as a complete illusion. The moment your deposit clears, it loses its individual identity and merges directly into a massive collective pool of institutional funding. The bank immediately channels the bulk of that combined pool outward to finance commercial and personal loans. Whatever isn't used for lending is routed into the bank's own investment portfolios and other broader financial market activities. Now, federal regulations and basic operational math require the institution to hold back a specific fraction of that total cash pool. This withheld reserve is strictly calculated to cover the expected daily volume of customer withdrawals and keep the physical branches running. Banks utilize that single deposit as the active raw fuel driving multiple concurrent banking operations. Let's look at how the math actually works. By lending out the funds from that collective pool, the bank generates a steady stream of direct revenue in the form of interest payments from borrowers. Compare incoming cash flow to your return. The large bar represents high interest revenue the bank collects from loans. The tiny bar represents the fraction of a percent paid to you. The massive empty space between them is known as the spread. Traditional banks achieve profitability by prioritizing the growth of this specific gap, using your capital as the primary engine. The mechanics of that spread directly explain why logging into your account usually reveals an exceptionally low yield on your savings. The interest rate you see is completely disconnected from any concept of fairness or equitable profit sharing. Instead, financial institutions run continuous calculations to determine the exact psychological threshold of their average customer. They offer the absolute minimum percentage required to keep you from moving your money to a competitor. Traditional banks know that moving accounts requires effort, so they rely heavily on consumer inertia rather than competitive yields to retain your deposits. Those uninspiring rates are a precisely calculated retention strategy, explicitly designed to protect and maximize the bank's spread. The trap here is behavioral. If you rarely compare accounts across different institutions, an annual return of 0.01% slowly starts to feel normal. This flowchart shows why that doesn't have to be the case. On the left, a traditional bank uses a huge portion of its revenue to maintain physical branches. On the right, online banks and credit unions operate with drastically lower digital overhead. Because they spend less on infrastructure, that saved capital can flow directly back to you in the form of a higher return rate. It proves that higher yields are mathematically sound the moment an institution is free from the burden of funding thousands of brick-and-mortar locations. And if you stay within the coverage limits, the federal insurance protecting your money remains identical across these different types of institutions. So the reality is clear. Your traditional bank will never voluntarily increase your payout unless it is forced to compete for your business. Which brings us to a rather obvious question. Once you know exactly how the spread works, why do so many people leave their cash in low-paying accounts for years? Choosing to remain in a low-yield account is an active surrender of potential earnings, leading directly into specific financial mistakes we see most often. Now that we've covered how banks turn your deposits into their profits, we need to examine the habits keeping your own earnings entirely flat. These are routine, everyday assumptions that feel completely harmless, yet they quietly drain real money from your accounts. Leaving money idle is an active financial decision. Thanks to inflation, the gradual increase in everyday prices reducing your purchasing power, money in a safe but low-yielding account is quietly evaporating over time. When you combine that unseen erosion with standard customer loyalty and simple inattention, you create a system where you are quietly leaving a significant amount of your own wealth on the table. The most common trap is simple habit. You likely opened your account years ago, perhaps during college or when you landed your first job. You stay there not because the bank offers a competitive deal, but because the act of leaving requires effort, and staying requires none. Financial institutions understand this inertia perfectly. A bank has absolutely no financial incentive to offer competitive rates to a customer who never evaluates the market. This line graph illustrates the compounding opportunity cost of blind loyalty. The flat red line represents your neglected account. The green line shooting upward is a competitive yield. Every year you stay, the gap widens. That empty space represents money lost to routine. This feeds directly into the second mistake, assuming all accounts pay roughly the same amount. If you have only ever used one bank, your baseline for what is considered a normal interest rate is artificially low. These two digital counters show the massive variance in the broader market. Basic accounts offer returns that move sluggishly, while competitive accounts roll up into massive, pulsing returns that are magnitudes higher. Without actively stepping outside your current banking ecosystem to compare those rates, it is mathematically impossible to know the exact scale to which your institution is underpaying you. In friendships, loyalty is a virtue. In the banking sector, customer loyalty does not yield rewards, it guarantees mathematical stagnation. The third trap is convenience. It feels incredibly efficient to have your direct deposits, your debit card, and your automatic bill payments all centralized in a single hub. But prioritizing that immediate ease traps all your available capital in accounts with near zero yield. You get a frictionless experience, but it comes at the direct expense of your savings rate. That desire for friction-free banking leads right into the fourth mistake, keeping a massive cash cushion in your checking account. It feels reassuring to see a large balance there. It eliminates the stress of mistimed bills or overdrafts. This segmented bar chart visualizes the mathematical penalty of hoarding capital. As your safety cushion grows disproportionately large, the vertical bar representing potential earnings shrinks dramatically. When excess money sits in a checking account for months, the opportunity cost compounds against you. And that brings us to the fifth mistake: waiting for your current bank to get generous. Many depositors assume that when economic conditions improve, their bank automatically passes along better rates. The institutional reality is much colder. Banks withhold rate improvements unless forced to act by the very real threat of mass customer attrition. If you are staying anyway, they have zero reason to increase operating costs to pay more. Waiting for your bank to proactively reward your patience is a delay tactic. Prioritizing temporary comfort and passive waiting does not protect your wealth. It directly funds the bank's profit margins instead of your own. Pacing quickens slightly, shifting to an empowering tone. Each of these isolated, harmless-feeling behaviors aggregates into a single point of failure. Your money is sitting completely idle. There's a sharp difference between genuinely saving money by putting it in an environment designed for active growth and merely storing money while it steadily loses buying power to inflation. The good news is that every single one of these 5 inertia traps is completely fixable. You do not need a background in finance to reverse the math in your favor. In the next part, we are going to walk through a clear, step-by-step plan to force your deposits to work harder. Optimizing your basic deposit structure is highly practical, mostly free, and it is an action you can take today to permanently alter your wealth trajectory. Right now, your bank is taking the cash you deposit, lending it out at a premium, and keeping almost all of the profit. You are doing the hard work of saving, but they are the ones getting paid. If your savings are earning a fraction of a percent, while the bank earns 5 times that on the same dollar, your money is losing purchasing power every month. Seeing that gap clearly is the moment you realize you can no longer afford to leave your cash where it is. We are going to implement a specific 7-step blueprint to plug this leak. The exact mechanics of this system will force your stagnant cash to start working for you instead of them. This sequence is designed to stop your bank from treating your deposits as free capital. By the end, you will have a system that captures the interest they have been keeping for themselves. Step 1 requires a deliberate, focused block of time at home. Block out about 15 minutes today to sit down and evaluate high-yield banking options. As you compare options, filter through 3 rules. Verify the institution is federally insured, confirm the absence of monthly maintenance fees, and ensure minimum balance requirements fit your reality. Eliminate the substandard options and pick an account. Do not overthink searching for a flawless option. A functional high-yield account opened today is vastly superior to a perfect one planned for tomorrow. Now, step 2 is the physical migration. Take your emergency fund and any unallocated cash sitting there and transfer it electronically into this newly selected vessel. Keep your primary checking account exactly where it is. Leaving it untouched prevents any disruption to your regular bill payments and daily spending routines. With just those 2 isolated actions, your existing capital is instantly earning a significantly higher yield. And because you verified the federal coverage limits, you achieved this multiplication without introducing any new investment risk. Step 3 removes human error from the equation entirely. We have to take memory and decision fatigue out of the ongoing savings process. Establish an automatic recurring transfer from your checking account into your new high-yield savings. Time this mechanism to execute the exact day your paycheck clears, automatically routing a portion of your income into the higher earning environment. Now we implement step 4, which is a strictly defensive strategy. Pull up your last 3 months of bank statements and conduct a rigorous audit of your transaction history. Hunt for parasitic costs. Isolate every monthly maintenance, minimum balance, ATM, and overdraft fee and add them together. If that aggregated total reveals a systemic drain, abandon your current institution entirely for one that guarantees free checking. By automating your forced savings and severing these routine bank penalties, you successfully neutralize the 2 most common forces of middle-class wealth erosion. Step 5 addresses the concept of rate decay. Interest rates naturally fluctuate, meaning today's top-tier high-yield account will inevitably lose its competitive edge over time. Establish a quarterly rate check habit. Put a reminder on your calendar every 3 months to compare your current yield against the market, applying the exact same logic you use for routine car insurance renewals. Step 6 is the checking account buffer rule. Calculate a baseline safety net strictly on a few weeks of known recurring expenses. Systematically sweep liquid cash that sits above this buffer directly into your high-yield environment to actively compound. Step 7 is focused entirely on unpredicted, non-routine income. This handles pay raises, annual bonuses, and tax refunds. The moment a windfall arrives, route it directly into your savings. This acts as a psychological defense mechanism, securing the cash before your mind has time to normalize it as available spending money. May's final maintenance rules ensure your financial machine continuously captures every spare dollar of potential growth, operating entirely in the background without requiring daily oversight. Look at the fully realized state of the system you just built. Your yields are optimized, unnecessary fees are eradicated, and your capital flows autonomously. Financial institutions will always find a way to leverage deposits. That reality is inescapable, but you have successfully ended the era of providing them that leverage for free. The mathematical mechanics of this strategy scale universally. It functions identically and provides the exact same structural advantage, whether your baseline balance is $500 or $50,000. If you know someone in your network who is still suffering from wealth decay inside a low-paying, stagnant bank account, send this video their way. To help establish a community baseline, go to the comments right now, type savings rate, and post the exact number you discovered during your research. Your savings behave differently the moment they start enriching you instead of just the bank. That is the point where your money finally starts working for you. I will see you in the next one.